Welcome to the BankTalk podcast, the show where we talk to leaders and experts from the community banking sector. Whether you are a current CEO or aspire to be one, this podcast will give you valuable insights and advice on how to run your financial institution better. Each episode explores a new topic with a guest who brings their unique experience and knowledge. Tune in and discover something new each time you listen.
Hi, and welcome to Bank Talk. I'm Charlie Kelly, your host and partner at Remedy Consulting. Today, we're talking to Adam Gregg. Adam is the president and CEO of the Iowa Bankers Association. So we asked Adam to come on the podcast today because we just wrapped up 2025 and are into 2026, and just wanted to kind of get his perspective on first of all, 2025, how did that go? And so getting into 2026, just, what should CEOs be looking forward to? Well, where should they be spending their energy from a regulatory perspective? And then, what else is going on in the bankers, in the bank world that maybe they should be keeping an eye on. So without further ado, let's get to Adam. So Adam, welcome to the Bank Talk podcast.
Thanks for having me on. I appreciate it, Charlie.
Okay, so I wanted to spend, you and I prepped for this a little bit, but I wanted to spend a few minutes talking without going into too much detail, 2025. I just thought, to me, it's such an interesting year with the change, over the Trump administration. And I know when we talked in the summer, it was still a new administration, and you kind of walked into the room to talk to a group of CEOs that we were talking to, and you looked a little stunned. So I thought we could replay a little of that. You can kind of tell me what, how the change in administration affected the regulatory and everything else you guys have going on over there. And let's start with that, see where it takes us.
Yeah, absolutely. Well, listen, I think there have been a lot of positive changes as it relates to the banking industry with the new administration. I mean, I think President Trump has done a great job of appointing some regulators who have the right mindset. Travis Hill with the FDIC recently confirmed that I think he's got the right mindset. Very smart guy. Same with Jonathan Gould at the OCC. I know our bankers are really pleased with the appointment of Mickey Bowman as the vice chair for supervision at the Federal Reserve. And I think she comes from a community banking background. She comes from a state regulatory background as well. So we've been very pleased with the personnel choices that the president has made. And of course, that often translates directly into policy. And, when I came on board with the Iowa Bankers Association in October of 2024, it was still the Biden administration. The conversation was around a tsunami of regulations that was really negatively impacting the banking industry and their ability to serve customers. And that's really gone completely the opposite direction. That tsunami of regulations is receding. I would describe it as more of a right-sized regulatory approach. A lot of the conversation on bank regulations is shifting back to talking about true safety and soundness of the institutions, materiality of the rules and regulations that they need to follow. Whereas as I talk with bank leaders, felt like in the previous administration, it was a lot about politics. It was climate, it was disfavored industries, and not really things that impact the safety and soundness of the bank itself. And so I think that's a really welcome shift. One specific example I might throw out there, the rules on small business data collection under Section 1071 of the Dodd-Frank Act. The Biden administration had gone forward with a really expansive, broad, and burdensome interpretation of that rule and that language, and it just very expansive, very burdensome, and would be very costly to implement, and also be a real interjection inappropriately between the bank and its customer. Now, fast forward to today in the Trump administration, that rule's being rewritten. They're heading down a path of a much more limited, less burdensome, less intrusive rule. And I think that's just kind of encapsulates the mindset of this new administration and new set of bank regulators to say, let's let banks do what they do and do it well. That's not to say there's no challenges out there and things that we still need to work on. But I think generally speaking, our bankers are much more positive about the regulatory environment in the new administration.
Oh, excellent. Excellent. Yeah. And I think I assume what you mean by the 1071 regulation is you've given a loan to somebody as an SBA loan, sort of thought all things were done, and then the regulatory oversight that they were looking for was to go collect a bunch of data that didn't really have anything to do with making the loan. It had to do with who the person was that got the loan.
Yeah, it was a lot of demographic information, and I think the thought process was, well, we want to make sure there's not discriminatory lending practices going on, and things like that. But I think their execution of that was so aggressive and so burdensome and so over the top, so beyond what was really truly authorized by the statute, that it was just too much. And so definitely appreciate the fact that that rule is being walked back and rewritten in a less burdensome way that I think will still fulfill that. I think that's a good goal, right? We don't want discrimination in lending or anything like that. But there's a lot of protections that already exist, and having a more limited rule, I think, will better serve the purposes overall.
Okay, great, great. Well, let's jump around a little bit if you're okay with it. I know the Iowa Bankers has a fairly sizable mortgage portfolio, and as I see all these rate changes and shifts, I used to be in that business, so I thought I'd just spend a couple minutes on how was 2025 in the mortgage space. It used to be an industry where mortgage rates changed by a little bit, and either you had to double the size of your staff or get rid of half of them. Like it was a roller coaster, and I imagine it probably still is a little bit. But what was 2025 like in the mortgage space?
Yeah. Well, you're absolutely right. So at Iowa Bankers Association, we have two wholly owned for-profit subsidiaries. One of them is Iowa Bankers Mortgage Corporation. And so to your question on 2025, heading into 25, we kind of thought we'd probably take a bit of a step backward from where we were in 2024. You think back to the beginning of 25, you had still persistently high interest rates. You still had home prices that were remaining high. And so that had really kind of slowed things down in the marketplace. But as things turned out in 2025, we kind of ended up in a neutral spot, and maybe even a little better in 25 than we were in 2024. As the year went on, you get into the third and fourth quarter, and you started to see interest rates come down a little bit. And that kind of loosened up the market, I think. I also think there's a dynamic where consumers are starting to adjust to maybe the new normal in the marketplace, and are accepting that it's going to be a long time before we see the record low rates that we saw in late 2020 and 2021. And so I think we started to see things move a little bit in the third and fourth quarter of 2025. So towards the end of the year, started to see more refinance activity, started to see more home sales go through. Our pipeline stayed full of deals. And so, as we speak right now, January is obviously a slow time in the mortgage business, but kind of expecting that trend of late 2025 to continue into 2026. We now service $9.9 billion of loans in 11 states. And so we anticipate in 2026, we'll cross that $10 billion mark in terms of loans we're servicing, probably pretty early in the year. I mean, so we see some opportunities for growth here in 2026.
Excellent. Okay. So I would assume that any refinances that are happening are because at one point rates were, they spiked up to as high as they were, right? And so
Right.
you're not refinancing business that happened back when the rates were aggressively low.
Yeah,
You're probably,
that's
this is
right.
probably
I mean,
relatively fresh business.
yeah, just speaking from personal experience, Charlie, we were able to refinance our mortgage back when rates kept going lower and lower and lower. And boy, it's going to take a lot for us to ever refinance or even move from our home because it's such a great deal. So the refinance activity that we're seeing would be on mortgages that happened at kind of at the height of the higher interest rates, and it's gone down far enough where it makes sense for the consumer to refinance that loan. And so, yeah, it's those loans from the very low interest rate days of 2021 are very, very sticky.
Yeah, I would
And
imagine.
that's a good thing.
Does Iowa service home equity loans, or is it just primarily
Yeah, firsts.
first
Yeah,
mortgage?
yeah.
Because I would imagine, and again, I haven't been real close to it, but I would imagine the home equity business is probably booming as well these days. If you want to try to get some equity out of your home and you don't want to give up that 3% or 2 or whatever you're sitting at, right? Then
Well, and you've seen home values increase really significantly, and so folks have more equity to be able to tap into on top of that. So, and I also think there was a dynamic when the home marketplace wasn't really moving. People didn't want to leave their low rate environment. Some folks who maybe needed an upgrade decided, well, rather than buying a home that's new to us, maybe we just need to,
sit on it. Yeah, sure.
yeah, let's sit on it and
Improve
let's
it.
do some refurbishments and make some improvements. And they may have accessed some of their new home equity in doing so.
Yeah. Okay. That's great. Okay, let's talk. And again, I'm going to jump with you a little bit here because there's just a few topics I really would like your opinion on. So let's talk about 2026. What's on the CEO's mind? I don't know if that question is regulatory or just what are they thinking about from technology trends? Anything that you're hearing out of the CEOs at the community bank level.
Yeah. Well, as I was thinking about this, and I was thinking maybe even a little more broadly than that. So, in my role here at the Iowa Bankers Association, I'm on the board of the Iowa Business Council, which the board of that are the CEOs of the largest employers in the state of Iowa, and participating in that gives me kind of a nice window into the overall economy, which of course impacts Iowa banks directly. So, a couple of things when we met in December that we talked about was, just generally looking at the marketplace and the economy and looking at the AI trends and really looking at this from a market standpoint, kind of the question of is it an AI bubble? And is that bubble going to burst? Has that economy, that little mini economy in the tech sector there become so circular where all these tech companies are paying each other that at some point that falls apart? And it matters because when you look at the economic growth over the past few years, it's really come from that sector.
AI, the
Most
data
other
centers.
sectors have been neutral or backing up somewhat. And so, if that is in fact a bubble, that could really impact things throughout the economy if it were to burst.
We'll be right back.
Ever feel like your tech budget's running the show instead of supporting it? You're not alone. Between bloated vendor contracts and outdated systems, a lot of banks are stuck paying more for less. And here's the kicker. Those big tech vendors, their contracts are built to protect them, not you. So if you're hesitating to make bold moves because of tech costs, it's time to flip the script. That's where Remedy Consulting comes in. We help banks take back control, cutting through the fine print, optimizing spend, and finding tech solutions that actually fuel growth. And we're offering a free review of your tech stack, spending, and vendor contracts. No pressure, no sales pitch, just expert insight to help you make smarter decisions. Even if we're not the right fit, you'll walk away with clarity and confidence. So go to remedyconsult.net or call 206-295-5776. Let's make your tech work for you, not against you. Thanks for listening to the BankTalk podcast.
So what are the folks that are small businesses that you might be talking to? Let's just assume most of them are not in the AI space. Are they feeling like it's stable, it's getting better, it's getting worse, or is there really just sort of wait and see? Like what are you
I
hearing
would
anything
say,
like that out of them?
I would say generally speaking, I would say it's kind of a wait and see with some modest optimism,
Okay.
looking ahead. Some other dynamics in Iowa, in the Iowa economy, you think of Iowa as very much an ag state, and we are, but the number one portion of our GDP is manufacturing.
Hmm.
So, manufacturing is very important to us. And you think of how that's structured in Iowa, you've got real big equipment manufacturers like a John Deere, and they've got a bunch of suppliers in small towns all across the state of Iowa. And so, watching the manufacturing space certainly is impactful. And of course, a big company like John Deere is very closely tied to the health of the ag economy as well. And so, you may know that we've been a bit of a downturn in ag in Iowa, generally speaking, for the past 3-4 years. And we're certainly hopeful that in 2025 we were going to come out of that. We didn't really. And so we're hoping that 2026 is the year when that happens. And that
And
has
what
a
is
lot of
that?
really positive follow-on impacts if we're able to do that, right? Because it does that mean more farmers are going to make more equipment purchases, which means Deere and other big manufacturers like that are going to need more from their suppliers that are, the major employers in many of our small towns across the state. So certainly keeping an eye on that.
So when you say downturn in the ag sector, is that prices for the most part, or
Yeah.
right, the crop prices aren't as high as they'd like to see them, or
Yeah.
something else?
Yep. That's exactly right. Iowa is the number one ag state. We're the number one producer of corn. We're typically the number two producer of soybeans, number one producer of eggs and pork, one of the top producers of cattle. So when I talk about the downturn in the ag economy, for the past 3 or 4 years, the cost of production of primarily corn and soybeans has been higher than the value of the production. In other words, farmers have been losing money on the production of corn and soybeans. Now, fortunately, the livestock sector has been on a little bit more of an upturn, particularly the cattle industry. And most Iowa farmers are diversified. And so when it's down in one portion of their business, lots of times it's up in another portion of their business.
Hmm.
But now we're talking the third or fourth straight year of that downturn, and things just start to get really tight. There's only so long that you can lose money year over year or stay neutral year over year and feel like you're making progress.
Sure. And I would
And
imagine there's a correlation there to land prices and everything else, right? If the land doesn't produce revenue, the land might not be worth as much as it was when it was
well,
producing.
boy, that would sure seem like sound economic theory, but it's not really the way it's played out. It's
Oh,
kind of
really?
interesting. Land values in Iowa have stayed very steady, despite the fact that the value of production has been down. In
Interesting.
maybe they have not increased as significantly as you would expect. And so there's good and bad to that. The good to that is because the land is retaining its value, farmers are retaining their equity. That gives them some additional options when you are in an extended downturn like this, like that, right? I mean, there's more restructure opportunities, things like that. The downside of that is it makes it very hard for young, new farmers to get into the business when land prices are so persistently high, and it's really hard to pencil out a business plan when corn and soybeans have been losing money for 3 or 4 straight years.
Gotcha. Yeah, that makes a lot of sense. Sure. Is that it's somebody buying in, especially buying in fresh, you got to figure out where the equity's coming from.
Right, exactly. And I think the core factor really comes down to there is just still significantly more demand for Iowa farmland than there is supply, even if the economics don't pencil out as well as we'd like in the
Hmm.
current moment. I think when you look at it over a 20, 30-year or longer horizon, at the end of the day, people still see Iowa farmland as a good investment, and I think they're right.
No. Excellent. All right. Let me turn that a little bit. Let me turn it back to the bankers conversation. Maybe it's the same conversation, but what are the bankers? Do the bankers have anything else going on from a 2026 perspective? Obviously, within Iowa, the health of the ag economy is huge, and and then with the manufacturers tied to it, those are all pretty critical items. Anything else that you're hearing out of the CEOs on 2026? Like, what are they paying? Do they care about AI? Do they, you know what I mean? Or is that just another buzzword to them because they're not seeing at their size level the benefit or the positives or negatives yet. They're still trying to figure out what it is.
Yeah, I think on AI, our bankers are trying to sort out, okay, what are the use cases for this in the banking sector? What will the regulators allow and accept? And that's still very much uncertain. I do think that there's a sense that this is a trend that isn't going away, that like any business, we're going to have to find ways to keep up with that and to maintain efficiency. And so AI presents an opportunity to do that and to make our workers more efficient. I mean, one of the big challenges I hear about, Iowa's a big community banking state. We're blessed that we've got 1,400 branch locations spread all across the state, but it can be hard to find people to fill the positions that are available. And so you do wonder, looking forward, are there opportunities where AI tools could help those smaller branches do more with less when it comes to, you know, underwriting an ag or a commercial loan or other processes within the bank. And so I do think there's opportunity there.
Okay.
I think one trend that's going to be really interesting in the banking sector in Iowa in 2026 is merger and acquisition activity. There were two really major Iowa banks that were acquired by out-of-state banks in late 2025. And sounds like there are a number of other acquisitions in the works in 2026. So obviously, industry consolidation is a trend that has existed for a very long time for a lot of different reasons, including regulatory, including just general, just the general instinct to gain economies of scale and
Sure.
things like that. But I think it's a trend that's probably going to accelerate in 2026 based on what I'm hearing.
Yeah, and we've kind of heard the same. It's, when you look at headwinds and tailwinds in that space, coming off of some of the paper losses and things that were going on a few years back, some of that's starting to clear itself up.
That's exactly right.
Yeah. So I would agree. That's everything we've heard so far has been that the trend is up. Question I think for any individual trying to make an acquisition or trying to decide whether to sell, it's probably, does it make sense, right? Who are you
Yeah.
selling to? Is it gonna fit the footprint and all that business?
Yeah, I mean, I hear at least three different major factors that impact all those things. Yeah, the paper losses on bond holdings and things like that rolling off, maturing, and so that is removing what has been a barrier to some M&A activity. Obviously, regulatory thresholds. Hopefully, maybe we can talk about this in a little more detail as well. But that $10 billion number, when you cross that and take on more CFPB regulation, you lose interchange revenue, things like that, really does drive acquisition activity all across the country. And as banks position themselves to either artificially stay under that that $10 billion number, or to blast through that and become a $13 or $14 billion asset size bank, that regulatory threshold makes a big, big difference.
So they're making business decisions based on just a threshold that's sitting out there, which they have to, I guess, right?
A threshold that, by the way, was set in 2010 as part of the Dodd-Frank Act, has not been adjusted since, has not been adjusted for inflation in any way. And so that makes it creeping regulation that becomes more and more burdensome.
Yeah, interesting.
And so, that's just certainly something that is a trend that we've seen in other states, and we start to see it impacting Iowa as well.
Are there any conversations going on at the federal level around? I'm sure there probably are on a regular basis, but around that $10 billion mark, is anybody trying to make changes to whether it be a cost of living adjustment or something? Right?
Yes. Yes, there are really significant conversations right now, actually. We're recording this on January 6th. We are anticipating even yet this week that there could be a package of bills introduced and considered with the House Financial Services Committee that would increase the various regulatory threshold numbers and index them to inflation going forward. And that $10 billion threshold is one of them that's in the mix for discussion on that and potentially bumping that up to a significantly higher number. Part of the debate around there is what is that going to apply to? Is it going to apply to the restrictions on interchange revenue that were brought about by what's called the Durbin Amendment to the Dodd-Frank Act.
Or what other restrictions are hit at that $10 billion level, you're saying? Yeah.
Exactly. So it's a little bit a question of the scope.
Yep. Okay. What changes? Yeah. If it changes $10 million mark, what changes? What,
exactly.
who benefits and who wins, who loses, I suppose, right?
Yep. That's exactly right. Let me mention one, there's just one other dynamic there on the merger and acquisition activity, and that's just succession planning for our banks. And not every bank has a clear leadership successor identified or readily available. And so that can help impact the merger and acquisition activity. So
if you don't have somebody that's next up,
yeah,
good opportunity, or maybe an opportunity to sell if they're not thinking about that at the time.
Exactly.
Last question on the regulatory side. Anything else going on? Anything else that maybe there's so many of them you can't talk about them, but give me a feel for anything else that might be big and that's either at the federal or the state level.
Yeah. Boy, there's a lot. We could probably do another whole episode on this, but a couple things. I mean, I want to continue that thread a little bit on increasing and indexing regulatory thresholds. We talked about the $10 billion one, but there are others as well. One of them is the FDICIA regulation that has to do with audit standards and various requirements around that. And it can be very costly. One of the main thresholds in that regulation is a $500 million asset threshold. That was set back in the 90s, and that hits a lot of Iowa banks. I mean, frankly, that impacts more Iowa banks than the $10 billion threshold does by a lot.
Oh, yeah.
And so the administration is bumping that, using their regulatory authority to bump that from 500 million to $1 billion.
Okay.
And so that's really significant for Iowa banks. That will be very impactful. Other things that come to mind, the ACRE Act. I don't know if you're familiar at all with the ACRE Act, but this was a banking industry legislative priority that would help us be able to pass on more savings to farmers in Iowa. And basically the original proposal provided 100% tax exemption for any loans that were backed by ag real estate. And that might sound familiar. It would put us kind of on similar footing as farm credit.
Okay, so let me stop you there and just see if I understand the tax credit. The tax credit would go to the banker that is making the loan and the income that comes from the farmer, or am I thinking about the tax credit as something else? Is it a farmer credits in some way, shape, or form?
Nope. It is a tax exemption for the bank for loans backed by ag real estate that would allow them to be more competitive in the marketplace against tax advantaged competitors. But most importantly, to be able to provide the lowest interest rates possible for the borrowers in that situation. And so what ended up happening with that proposal, I told you it was originally 100% tax exemption. Well, what ended up happening is it was reduced to 25%, but it was included in the One Big Beautiful Bill that President Trump signed. That's a really big deal. I mean, there weren't a lot of new tax policies included in that final bill. It was a lot of permanency and extensions of previous tax cuts, but not a lot of new things. Really, about the only new things were presidential priorities like no tax on tips, no tax on overtime, no tax on Social Security, things like that. But then you add in this ACRE proposal. And so while it was a little less than what we saw it, the fact that it was in at all is a really big deal. And so now we're working through the Treasury and IRS's guidance on how banks can access those savings so that they can pass them on to their farmer borrowers.
Oh, interesting. How long does that secondary process take? As until somebody sorts it out, or like who's responsible for saying, Bank A applied it properly and Bank B did not? That's just the IRS and figuring out.
Yeah, the IRS and Treasury have already issued some interim guidance on how to do that in recognition of the fact that, it's renewal season for operating lines and things like that. And so they've provided some interim guidance and sought some feedback from the industry. And so we're in the process right now of providing some feedback on how to make this as usable as possible for our ag lenders across the state.
Okay. But in general, what the regulation says is if it's tied to the land, That's the kicker, right?
That's right. That's
Okay.
it. Yep.
So it still can't be
That's
equipment,
exactly right.
can't be the cattle, can't be the maybe can be the crop, but I'm sure there's got some regulation to determine what title of the land means.
Yeah. Basically, what it means is if it's secured by ag real estate,
Okay.
it's potentially eligible for this exemption. And there's a lot more to it. They've got this guidance, which is like, you know, 15 pages worth of guidance on it, and that's just kind of the beginning of the conversation. So, like everything involving tax and finance, there'll be some complexity to it, but that's really the core of it.
Yeah. But
And
overall, a good thing.
as we, back to when we were talking about the ag economy generally, it's been an extended downturn. Farmers need some help, and a good way to do that would be to help them be able to borrow money for less.
Yeah. Lower their payments, all that type of stuff. Okay. All right. Anything else? Anything else in there from a regulatory perspective that jumps to mind?
Let me give you two quick things. One would be the issue of deposit insurance and the appropriate levels for that. I think there's been some congressional interest in this topic. There's been some discussion around should there be, right now it's $250,000 across the board for deposit insurance. But there was some conversation to say, should business transaction accounts have a significantly higher number? They represent the biggest run risk that exists if there were a systemic situation that were happening. And so perhaps providing some additional coverage would help prevent that from happening. There's conversation around should that 250,000 for all accounts be bumped up to account for inflation since it was last increased to say 350,000. Should that be indexed to inflation going forward so that that continues to protect the same amount of wealth that it originally did when it was set at 250,000?
Interesting. So if I'm thinking about that, the two sides of that equation are bankers who probably want the deposits to be as high as possible, and the people that might be against it might be the sweeps people or somebody. Right? Like I might be overthinking it, but
No, I
like the
think
sweeps
I
folks
think you're
make money
thinking
once the
about that correctly. There's also philosophical debates. I mean, I think smart people can have differing opinions even outside of the business context of who gains and who benefits, just to say, okay, how much do we want to protect against risk? And at some point, if you protect too much against risk, you invite moral hazard and inappropriate risk taking, right?
right.
So I think what I've found on this issue is if you had 100 bankers in the room, you probably have 100 different opinions on exactly what's the right level of coverage and to what extent and all of that. So
Okay.
a
Interesting.
wide array of opinions on that.
Sure, but I would imagine that no matter what happens, if the number goes up, if the coverage number goes up, insurance premiums probably follow anyhow, right? I would imagine. So even though you're protecting more, insurance premiums from the banks would go up in order to be able to secure the 350 versus 250 as an example.
Yeah. Yeah. Well, and interestingly, that's part of the discussion as well as how would they really need to, or is the DIF, the insurance fund that pays that in a strong enough position where you could provide additional coverage without significantly increasing premiums.
Hmm.
And so there are some differing plans out there. I'm kind of the belief that if there's going to be additional coverage, probably need to make sure that we're handling that through some level of premium as well. If you're expecting additional coverage, probably need to make sure that we're paying for that one way or another. I'm a little skeptical of plans that don't require that, but there's smarter math people than me out there who can figure out what the right reserve levels are to be able to handle that.
Gotcha. Interesting. Okay. And then was there another one? I think you
Yeah,
said there were two items. Yeah.
the other topic that's really hot right now is the issue of stablecoin and
Okay. Yep.
and to what extent that represents a threat to the bank's role as an intermediary and all the positives that come from that. It's important that the bank exists to take those deposits and to make loans in a safe and sound manner and essentially double the money supply in the economy. It's been something that's powered wealth creation in the United States for hundreds of years now. And so the concern around stablecoin, the Genius Act was passed and signed by the president this past summer. And one of the key provisions around the Genius Act, which provided welcome regulation to the stablecoin marketplace, was they said that issuers of stablecoin can't pay yield or interest or rewards. And the reason for that was stablecoin is a special type of cryptocurrency that's meant to be a stable payment mechanism tied to a currency and not an investment, not, compare it to Bitcoin, which fluctuates wildly up and down. That's not really what stablecoin was intended to be. Stablecoin was meant to be something that stays stable, tied to the value of the currency so that you can have a reliable method of payment.
Yeah, and just again for me to catch up to this conversation, in a scenario where an issuer says, "I will issue $1 billion worth of stable coin," they have to, in that scenario, put up currency, let's say $1 billion in an account to validate, right? To validate that, number one, the billion's always there, and then it tracks to the stable coin. You're saying that the billion in that scenario I just gave you, you cannot pay interest on the billion that's sitting there as security or collateral, or so, is there another scenario that I'm not thinking
Yeah,
about?
basically what the regulations required is that there be a one-to-one reserve for every dollar of stablecoin. There's got to be a dollar of reserve. Now, it doesn't have to be held as cash. It can be held in treasuries. And so, but the ultimate holder, so the issuer can get paid, say, the interest on the treasuries that they would be entitled to. But what they can't do is pay that out to the holder of that currency because
Oh,
it's not meant to be an investment.
yeah.
It's meant to be, this is a sort of a temporarily converting these dollars to the stable coin so I can either buy a different cryptocurrency, make a payment, whatever the case may be. So that was the clear rule that was laid out in the Genius Act. But what's happening is while the issuer may not be paying that, maybe an affiliate of that issuer is, or the exchanges on which those coins are traded are paying that. And I guess I don't know this directly. I've been told, however, that maybe the issuer is paying those rewards to the exchange, who in turn are passing them on to the ultimate holder of the coin.
Hmm.
Regardless, it's a clear workaround of what was, I think, pretty clear congressional intent on what stablecoins are and are not supposed to be. So it's a really hot issue right now because it does go to the core of what is the role of the bank, what is the role of stablecoins. And so trying to lock down what was that congressional intent around paying interest, rewards, and yield on those stablecoins.
But yeah, that's fascinating. Okay.
Yeah,
No,
it's
that's
a
great.
whole new world. When I started a year ago, the stablecoin issue wasn't that hot of an issue. And so I have, on behalf of the banking industry, worked hard to educate myself and understand the issues and understand, where we need to stand on them uh, as an
Yeah,
industry.
and to me the dynamic is interesting, right? Because when you think of a Bitcoin as an example, I would say Bitcoin was meant to be more of an investment. Now, when you start getting a stable coin, now it's transactional, right? And again,
Right.
this is a poor man's opinion, and probably not a very educated man on the topic. But when you talk about transactional, something you can do as a transactional, that really then gets into a lot more to where the community bankers sit, right?
Yep. Yep.
As an investment,
You
I don't
got
know,
it.
unless you have a trust area or something, that the investment side of it doesn't quite as affect you as much. But when it becomes something that where you can avoid interchange revenue, or whatever they're going to do with stablecoin, just a lot of impacts, I would imagine, to the bankers.
Yep. Yep. You've got it.
Excellent. Well, I tell you what, Adam, this has been awesome. I appreciate your input today. I think you hit on a lot of topics, and like you said, I'm sure we didn't cover a bunch of things we probably still should. But I think as far as get ready for 2026, it's coming your way, whether you want it to or not. I think you have some great comments and really some interesting moving parts going on, from a regulatory perspective.
Yeah, absolutely. It's an interesting time to be introduced to the banking industry and right at a time of lots of change, right? Positive change from a right sizing of regulation standpoint, challenging changes when it comes to new products in the marketplace and new technologies and the potential impact to the industry. But I feel really blessed to have the opportunity to serve in this role and to represent the Iowa banks and to communicate with the public and our el- elected officials at the federal level to help communicate what those impacts would be on the industry and to consider the follow-on impacts to the rest of the economy as well.
Excellent. So I know you said the farmers are probably feeling a little stressed. Bankers, if I were to ask you that same question, positive, negative, wait and see, just in general, is the outlook good, bad? I mean, like, or is there just, a bunch of headwinds, a bunch of tailwinds, and you don't know what the outcome is going to be? Everybody's waiting to see.
I think bankers are generally upbeat. I think generally expecting some modest growth going forward. I think we're seeing some interest rate stability from the Federal Reserve and the possibility of maybe still a couple modest decreases still coming. My bankers think that that's going to improve deal flow and provide opportunity for the banks. Yeah, we're watching the ag economy as we discussed in detail, but I guess I also want to emphasize, I get asked all the time, and I've asked my bankers a million different ways, is this the beginning of something like the 1980s farm crisis? And the answer has been a resounding no. Our bankers don't think this is a farm crisis, don't believe it will be, a decade-long downturn that has really negative impacts on the ag economy and on banks as well, for that matter. Instead, bankers view it as just an extended downturn that will return to its cyclical nature and eventually will be an upturn. And so I do want to emphasize that we do not believe this is the beginning of a really serious farm crisis. It's just a cyclical downturn that's extended for a few years.
Okay, excellent. No, that's a great perspective. Well, Adam, thank you. Thank you for joining us on Bank Talk today, and I appreciate all your comments.
You bet. Thanks for inviting me to be a part of your show.
Okay, that's it for Bank Talk. This is Charlie Kelly, your host. Have a good day and keep on learning.
Thank you for joining us on the Bank Talk podcast brought to you by Remedy Consulting. If you enjoyed today's conversation, please rate, review, and share our work with others. To stay up to date with future episodes, be sure to follow the show and turn on notifications. Thanks again, and we'll see you next time.